Hey, I'm Joe Connolly with Barry Ritholtz of Ritholtz Wealth Management, who's made the observation that the way that a lot of financial services firms advertise and do marketing now doesn't really work anymore. Numbers and rankings aren't as interesting in terms of marketing as stories about people and about customers. Barry, what do you mean by that, for instance?
Well, for instance, in the old days, there were a lot of mutual funds that were marketed by things like how many morning stars they had, what percentage ranking it finished the year. Lots of magazines would come out with, these are the mutual funds to own next year, and it was all about the mathematical performance. The problem with that is it varies year to year, so you don't have something to hang your hat on if you're selling a mutual fund. And it turns out most people respond better to a narrative story than to a bunch of statistics.
For instance, like what would work? What do they want to hear about?
So they want to hear about why they should own a particular fund or index. And I'll give you the perfect example. All the academic data says you're much better off, instead of trying to pick stocks or instead of trying to time the markets, just buy the whole market, put it away for 50 years, and when you retire, open up your first account statement. You probably will have done really well. That is really boring for most people. Most people don't want to hear, wait, just own anything? What about all the people I see on TV telling me to buy this stock or buy that stock? Or what about the stories about this management team or that product pipeline? Those are really fascinating stories that capture people's attention. The reality is simple is better, cheaper is better. But it's kind of a boring approach to investing.
So if somebody is talking to you and they want to hear about this management team or that management team, what do you tell them about how you judge a management team?
Well, I tell them I'm completely terrible at it. I have no skill at it, but at least I figured out that I can't do that. Most investors haven't realized that they lack that skill. And I could give you dozens and dozens of examples. People forget that Steve Jobs was fired from Apple because this guy isn't a CEO and he really doesn't know how to run a company. And it was only when Apple had their near-death experience that he was, out of desperation, brought back and quickly or not so quickly proved that he had an idea for the iPod, the iPhone, the iPad, and they became one of the biggest companies in the world.
So you don't tell your clients, though, I assume, invest in index funds. You tell them to do something different from that.
Well, part of their portfolio is in index funds. Okay. Part of their portfolio is in a form of indexing that is tilted, again, towards the data, towards smaller cap and towards cheaper value companies, because all of the research that's been out over the past 100 years has taught us that over long periods of time, value will beat growth, small cap will beat large cap, but that's really a boring story and nobody wants to hear that.
So how far ahead is the data that you would be looking at in a meeting with a client today?
Well, we discuss future liabilities, meaning here's where you are today, here's what your assets are, this is what your future income flow looks like. What future liabilities are you going to have? Are you going to be sending the kids to college? Are you going to be buying a vacation home? Are you going to be retiring at some point in the future? And what are each of those things going to cost? So when we look at future data, what we're really looking at is what are the needs of the individual going to be at the future. What the stock market does yesterday, today, tomorrow, it's almost irrelevant to, hey, I need X thousands of dollars a month in 30 years when I retire.
So what will be a common story that your client will tell you about them wanting to buy a beach house or something? What do you hear all the time?
What we mostly hear is, here's what my portfolio looks like, and let me explain to you how it got that way. Before we even get to, I want to go on vacation or I want to buy a sailboat in my 60s, the stories we usually hear are, this is what our portfolio looks like, and it got to this condition because I listened to all these stories that sounded so compelling. It sounded sophisticated and complex. it turned out to be somewhat expensive and perhaps not the best performing, but that's sort of a feature of the way Wall Street uses stories to sell products.
So now you're going to fix them up by changing some things?
Making it boring. Right. We like to make it boring, and we have to give a story why boring beats exciting and why cheap beats expensive. And the story goes something like this. We're really not, as a species, not very good at thinking about the future, imagining what our emotions will be like at some undisclosed point. And the reason for that is we weren't evolved to make risk-reward decisions in the capital markets. Humans are the most successful species on the planet because we're very good at adapting to a challenging environment and staying alive long enough to pass our genes along. So the things that make us successful, the ability to think quick, the ability to recognize patterns, the ability to not dither over certain things and make a snap decision, jump out of the way if you think there's trouble, all those things are great on the savannah, but in the capital markets, they're very, very deadly. If you panicked every time the market dropped 10 or 20%, you wouldn't be sticking around long enough to participate in the upside. So we have this system that's fantastic as a species, but it's terrible in the stock market.
So don't try to plan for a specific number. Don't say, I need $1 million, I need this, I need that.
Right.
Because you can't figure that out unless you just totally fall into it by dumb luck.
Well, you could come up with a target and invest towards that target. There are people who begin their investing career with enough capital that they don't have to take a lot of risk. So if the market goes up and down, it doesn't matter to them. They have enough capital that they can own bonds as well as stocks, and the bonds act as a cushion for when the stocks do this. There are other people who they really need to see the market do at least average for the next 20, 30 years in order to hit an upside target. So people's future requirements will to some degree affect how much risk they need to embrace today. And reward is just the flip side of risk.
Is there an ad that you have done for Ritholtz Wealth Management that really worked well for you, or an ad from a company whose ads you look at and you think they're very good?
So we don't advertise, but what we do is we tell stories through our research and our commentary and our writings. The firm is about 25 people. About 7 of them work on the research and commentary side, and we try and explain what happens in the market in a way that's compelling and tells a fascinating story, but also relies on real evidence and data so that the story isn't just a lot of empty promises. The story is, here's what the data suggests and here's why it's important to you.
So it's not a one-line social media story.
Oh,
it's
no.
an interesting 1,000 or 3,000 word story with facts and calls and judgments.
That's exactly right.
3,000
words is a little long,
but it's not a 2-sentence story.
No. Look, to explain the world is complicated, finance is confusing, humans are very subject to emotions, fear, greed, panic, desire. All those things combine, and it makes for a complicated, nuanced story. It's not a black and white story. There are all sorts of shades of gray. And communicating that to a public in the face of hundreds of millions of dollars of advertising, the advertising effectively says, this is complicated, it's expensive, and we're the only ones who understand it, so therefore pay us a big fee. That's the other side of the argument. Our story is really, it's a little complicated, but when you reduce it to the simplest basis, you want to be invested for the long term, you want to keep your cost structure low, and you don't want to make mistakes. Investing is one of those areas where mistakes accumulate and compound over time. So we've heard countless stories from people who said, I was out of the market during the financial crisis in 08, 09, But when things started to turn up and you had come out and said some positive things about the stock market and the economy early in '09, and you and everybody else who said that, I thought you were crazy and I haven't gotten back into the market. Well, here it is 9 years later and the markets have almost tripled. What do you mean you haven't gotten back into the market? Those are the sort of mistakes that people make that become very difficult to recover from.
What did you learn before you were a researcher for many years? You were in the trenches. You were a trading desk guy on Wall Street. What did you learn, if anything, on a trading desk on Wall Street that applies to the average investor?
Probably the most important thing, I'll give you two things. One was humility. It's important to understand that, hey, in baseball, if you hit 300, hey, you're going to the All-Star team. In trading, it's pretty similar. As long as your losses are managed, having 3 out of 10 trades work out, you are doing really well. In investing, that doesn't apply. Investing, since you're looking at things over the long term, you don't get to make, all right, this didn't work out, so on Tuesday I'm going to try something different. You have to invest in a probabilistic method that can sustain you over 20 or 30 years. You don't get to do a redo. And then second, being a little lucky is important.